right, we're going to move on, everybody, because we got to talk about investors. When they're concerned about market volatility, some turn to financial advisors like Charles Schwab for advice. In this week's edition of Bloomberg Businessweek magazine, there's a feature story on Schwab and the $9 trillion in potential investments that are just sitting out there on the sidelines, waiting for someplace to go. Roben Farzad is a former Goldman Sachs analyst, now a writer for the magazine. Forgive me. He joins us now to talk about Schwab's attempt to get people into what Schwab calls the most violent market he has ever seen. And he's seen a lot of markets, hasn't he?
He has. His very visage, his face inspires kind of a buy and hold confidence that very few other people, maybe Jack Bogle or Peter Lynch, could. So it's more like, you know, they used to say when E.F. Hutton talks, everybody listens. I think that's today's Charles Schwab.
So what is he saying that we should be worried about?
You know, underinvestment is a worry for them, both institutionally and Charles Schwab being
for his
the
company,
discount brokerage, but also for the investor, the individual investor who's disproportionately still scared, still, you know, piling gold bullion under the blanket and storing freezers full of $50 bills. That's not going to help you in an inflation-adjusted world.
And I mean, some might say his livelihood depends on this, but actually, as a company, they've been diversifying, correct? So they're not so banking so much on those individual investors as much as they used to be.
Correct. They're one of the great survivors of really Wall Street's catastrophe at the end of '08. I mean, just by dint of luck, they happen to have a bank. And when people were withdrawing their money from other institutions that were failing, they just were plowing it into Charles Schwab.
So he knows there's a lot of money out there.
He knows there's money out there, but it's restive money. And it's actually costing the company money to refund short-term rates back to clients while they wait for the yield curve to stabilize.
Let's talk a little bit about the commentary that you wrote. I love the tone. You're a very good writer. But it's interesting. It almost seems to me as if you're comparing this credit crisis we're going through to the panic of 2008. And clearly, we're not that bad off. Or have I missed something?
They're not different. This credit crisis has started maybe at the beginning of 2007, middle of 2007. What people don't realize is it's kind of jumping into different manifestations. I think the fiction that a lot of people were romancing last year was that this is going to be a V-shaped recovery, that somehow stocks surging 80% would suggest, you know, the unemployment rate would get cut in half back to 5% again. And no, this is not the way a deleveraging kind of a once-in-a-lifetime credit shock plays itself out. And the latest manifestation is Greek and the sovereign world. All
right. It's a great read, everybody. Do check out the new Bloomberg Businessweek. It's hitting newsstands today. Matt, you got it?
I have it.
He's got it.